Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by North Star Bar Charts co-founder Patrick Karim. Patrick, good morning. How are you?
Hello, sir. I'm doing great. Thank you.
I'm really looking forward to this. And for those who listened to the podcast with your business partner recently, Kevin Wadsworth, we're going to try and touch upon a completely different set of charts and a different set of subject matters here today. And I know that you were saying off air, actually, silver's obviously very interested at the moment. So I'm sure we're going to talk a lot about that and look at different time frames, short, medium, and long term. And again, we're going to have a look at some completely different charts as well to make sure the conversation's completely different. But yeah, Patrick, maybe silver is the place to start because I know that you're, from a chart point of view, very bullish on it. But bring up the screen share and what can we see at the moment? Before you answer that, I will say this has been recorded on Wednesday, the 20th of August. This will likely go out Friday, the 22nd of August. So apologies if there's been a couple of changes in the charts between now and then, but just thought I'd timestamp that for people that are looking to utilize the charts for possibly any trading.
All right, let's do it, guys. Okay. All right. So I like showing this chart, Robert, because often people like, I don't want to say people like in a bad way, but it, they're always like, and I'm trying people to get out of that rut of, silver's manipulated, or
Mhm.
silver, there's silver baked in demand because they're going to do solar panels and all that stuff. Guys, look, there's stuff I know today. I might repeat this, but try to do this reflection honestly, guys. There's stuff I know today that I didn't know yesterday, right? I talked to somebody, oh, I learned that. That's new. As soon as that happens, and it happens to everybody, right? I don't think anybody does not learn anything new. You have to assume that there is something important that you will eventually learn that you don't know today. Think about that, guys. So whenever you go crazy and you hear this nice narrative and it crystallizes in your head, and then you tell your wife, "I'm mortgaging the house, I'm putting everything on whatever Bitcoin, silver." Think about, hold on, maybe my little bit of information I have that I'm basing this crazy like with no risk of money management. I'm putting a whole bunch of money in something. What if there's a counter argument to that that offsets that eventually, that will offset the price, right? There's always, it's the unknown. It's very hard, Robert, for people to see the unknown. Even for me, like it's like we like confirming our bias with the known, right? There's a whole bunch of unknowns we don't know, and we have to accept that. And I like to think that there's way much more unknown than I know. And remember, I think it's an old adage, like as soon as you learn something, you the more you learn, the more you realize you don't know anything. And it's, apply that to charts, guys. Apply that to anything you do in life, and you're going to be more humble. You're going to say, okay, I'll stay. Okay, fine. I have this bit of information. I think the price can go up for X reason, whether it's that or not. And often it's not just that, it's that and a lot more stuff you didn't know about. But at least use sound risk and money management. Don't go crazy, guys, because if ever your intel, your research is not what drives the price chart, then you'll be safe. You won't, because remember, it's basic math. If you do a 50% drawdown on any one of your trades, you need 100% to break even. 100% if you go down 50%. That's like crazy math. So be super, just be safe, guys, out there. So I'm going to show this chart. This is the chart I've seen. So on this left hand side, I have the yearly chart, yearly close chart for gold versus inflation. And on the right hand side, I have silver on the yearly chart, just the silver chart, price and fiat. And this is the closest chart I found from a macro, like when you put a nice ratio chart of two major asset classes, gold versus inflation or gold versus the stock market, like something other than fiat, it gives you a glimpse of these capital flows of from a macro perspective. Look at the silver chart. Even I know it did peaks, gold did peaks in 1980, but on a yearly close basis, it removes those blow off tops, right? It just on a yearly close basis, it removes a lot of that quarterly noise, monthly noise, daily noise. It removes all that. And here, guys, it's not this is the open of 1980. The close here was right down here for silver. The close of 1980 was actually down here. If I would have put a line chart, it would have stopped right here. But look at that. Gold versus inflation and silver. Here's their peak here back in 1980s, 79, 80. Look at the 2000s. Look where silver peaked, right about that same area that it did back in the 1980s. Gold, same thing, right about that same area peak. Here's the blow off top of 2011, that little wick. Here's the silver blow off top all the way up here. And after that, back in 2020, good. Look where gold halted price in inflation. Right again, that area, that zone, like previous price action, guys, does matter. You could see silver, it's on a yearly close basis, also more like hitting that line again. So here was 1980, 2011, and here again 2020. Silver didn't quite do it here. So, but it's still in the same area of resistance. And for me, that's a clear neckline that gold closed above back in of last year. So gold did have a confirmed yearly close price inflation. That's a beautiful breakout, right? Whatever you want to call that, cup and handle. I'm not a stickler for the cup has to be X percentage from essentially what a cup and handle is, guys, or inverse head and shoulders. It's just a higher lows. So what's an uptrend? An uptrend is higher lows and higher highs. That's all it is. People they like getting fancy there with all that. So here's the bottom of the cup. Here's the handle, higher lows, and once you clear that neckline, horizontal neckline, it confirms that you have a higher high, right? There's no higher highs here. Then you get a confirmed higher high. Hey, that's an uptrend. We got an uptrend here. And gold, what it did the following year, it just kept outperforming inflation. Look at silver following in gold's footsteps. Silver, if it closes the year here above like that neckline's at about $31. If it closes anywhere here, 35, 36 at the end of the year, it's a confirmed historical yearly defined breakout. It's like you'll never see that again unless we have a secret to living forever there, being vampires or else, I don't know, like something. This is, you'll never see that again. It took 40 years, 50 years for this thing to morph into existence. It's breaking out. It broke out in 2024 for gold. It's going to break out for silver in 2025. Like highly likely there were, unless like something crazy happens and it closes below. That is big picture stuff. That is makes you super bullish. Look here in the 2000s, that run there, it made silver. It used a lot of fuel to retest those highs. It was stretched from the moving average. It wasn't time for it to break out that time. But look, this time it just pulled back a little bit and then it pulled back coiled. It's very coiled and tied to the long-term moving averages. Silver, this is practically one of the lowest risk entry points on a yearly close basis for silver, considering that from the macro perspective, gold is outperforming inflation, and you see these longer-term trends, they follow each other. It's just crazy stuff, man. It's like, I don't want to be like a silver guy, but at the same time, I'm a silver guy because when I say chart like that, I'm telling you, okay, fine, it's great. So this chart is for position traders, investors, long-term guys. It's the bull market is resuming upwards to, like, this is the type of pattern that leads you to $100 silver there. That's the type of pattern that permits you to reach 60, 80, $100 there. They're built off these huge patterns. Okay, so that's a big picture. That's the preface. That's the big picture for silver. All right, but Patrick, I can't. Okay, fine there. But what could I do on the daily chart? Could I action? Is there something on the daily chart I could action? Well, I could zoom in on the 8-hour candle chart. Mm-hmm. Right here, we had silver. Here, guys, I have the 8-hour candle chart. I have the small blue line is the 8-period moving average. So the 8-hour simple moving average. The red one is a 36-period simple moving average. Low risk entries are where the price is coiled and tight, close to those moving averages and starting to move up. So you had the low risk entry here, it went sideways, but then after that, you had a chance. It doesn't mean once you get a breakout here that it goes to the moon, but it's telling you if I had a chance of going, a better chance of going up than down, it happens here, then maybe here after the classic correction above a breakout line. And then after that, you have even a horizontal line breakout here. This is what you should look for, guys, to enter. You need that pattern. So they don't always morph like that, but look for something like that. So what's happening to silver here? This possible breakout line is morphing into existence. Here I have one reaction, two reactions. We're going to have to wait to see if we get a third one. Mm-hmm. Let me get the little squiggly path. Let's see what happens here. No, you would want, this would be a bullish roadmap. I'm not saying that's what's going to happen now, but it would look something like this: a third reaction here, then you trust it, and then you get a breakout. I think and even here, I have a wall of resistance. On the right-hand side is volume per price. At the bottom here is volume per date, per candle. This is volume per price. So it gives you, the more the price stays in a congestion area, you see the volume increases. Those are nice, thick support takeoff platforms. Just like here, you see all the price stayed all here in this range. Look at the huge volume here. And look what happened once the price went above that high volume node here. Once it went above, there's like a vacuum. It just floated up. Because there's nothing in front of it until it discovers a new congestion area, and then after that, you create it. So now we're creating another type of congestion area, or if the price is below its resistance, if the price is above its support. So that's how I identify low risk entries. And I have to keep saying this, Robert. Whenever I say that to people, there's no low risk entries for silver. People go, Patrick, what are you, bearish? It's like, no. The reading, it's like people who own something, they seek confirmation bias. If you say something that's not anti, but it's not 100% aligned with you telling them that it's going to the moon, they will see it as bearish. They will see it as, what are you doing, Patrick? What are you talking about? Because crying out loud, I just did a yearly chart telling you that it's super bullish on the higher time frames. If I'm telling you there's no low risk entry here on the 8-hour chart, it's because I've just shown you how I define a low risk entry. And I'm sorry, but there's no low risk entry here. The low risk entry will be above $38.30, and as time moves, $38.20. It's going to be above that, above that dash line. It's going to be above this descending trend line, because what's happening now is, as soon, and I've done this chart many times on Twitter, guys, or X. I had this line here. Yeah, I had this longer term line here, and I was calculating, could we reach 40 before August? And we just ran out of steam. Fine, we got closer. But as soon as this rising support line failed, that's 100% you're entering correction mode on that time frame. And guess what happened? Well, the price went down, sideways, up, and a whole bunch of people saying, oh, that's the low, I'm going in. But okay, then it goes down. Then, oh, that's the low, I'm going in. But eventually, maybe that thing doesn't break out now. Maybe it breaks out down here, there. I don't know. Like, who knows how that's going to look like? It doesn't have to break out. It could take a while before that thing breaks out, right? So low risk entry is not entering when you're conscient that you're in a correction. The low risk entry is after the correction ends, after you think you have the odds, the evidence that the correction has ended, not during it. Look at goodness. Anybody here entering in this thing here? I don't know how to draw this one here. Even here, it lost that rising momentum. Oh, fine. Then the correction, it rallied upwards, still below that line. Then after that, it faltered. Even here, you had another clue to get out of there. And this could happen there. You could have a crazy wick down there. It could happen. So don't try to be a hero. I know patience is a very hard thing, to be on the sidelines. But for me, that's the short-term outlook for silver, is until it's able to close above 38.20. There's no bueno. Here I could go on the daily chart, remove all drawings. Same thing on the daily chart. What we're doing now, guys, it's multi-time frame analysis. It's I don't know if you've seen like the Russian dolls. One fits into the other. The yearly chart super bullish, but before the yearly chart could keep going up, the smallest of the time frame has to start turning up. There's no uptrend. There's no resumption of a long-term uptrend until the shorter-term downtrends or corrections end, right? Mm-hmm. So here's the silver chart on the daily chart. Still nothing. Still in correction mode. So what that means is you're here 38.50. Until you clear that, you just don't know how long that's going to last. Imagine there's a huge market downturn taking everything down. Well, at least if you're on the sidelines and you waited for a bullish resumption up here, you're safe. You don't. This is another way to see it. All important market tops start with bullish looking corrections that fail on the smaller time frames, but not all shorter term bullish corrections that fail are market tops. So this, I could probably zoom into 2011 on the daily chart, and I'm sure there was a super bullish correction here. Let's do it there. Here's that two reset. Let's go back to 2011. Here.
Oh yeah, yeah, I can. Yeah, even with the naked eye, I can see that there's going to be a similarity here.
Yeah,
Yeah.
it's like here, here,
Mhm.
here, and you think it's gonna resume upwards, and then it fails, and then it recovers, and then it fails, then it recovers, and then you're in a bear market. But you got to remember, I'll zoom out to the monthly chart. Why did it fail? Why did the odds increase of silver failing on the daily chart? Well, look how stretched it was from the moving average on the higher time frame. So that's a distance from the 3-year moving average or 36-month moving average for silver. And I'll put a line all the way up here. So that is how stretched it was. It was as stretched as it was back in the peak in 73, 74. It was not as stretched as it was in 1980. But from a mathematical perspective, you can notice that the data points, the majority of them are below this. Like on the bell curve, what is that? It's like less than 0.5%, less than 0.5% of the time, silver is able to stay above. So whenever prices up here, FOMO's crazy, break the banks, break JP Morgan, all that stuff, you hear it here. But if you look at the chart, you say, my goodness, it's like we're in froth. Like, and people, oh, it's going to different, Patrick. You see, we're going to go as high as this outlier territory. When I hear that, Patrick, this time's different. This time we're going to go as high as we did in the 70s. Well, you're not playing the odds. You're telling me that something that's not in the norm is going to happen. That's not playing safe. That's not playing the odds. The odds are that you're stretched, you're in FOMO froth territory, and any type of correction that starts on the daily chart, respect it, get out, because now you're having a correction on the smaller time frames while the price is stretched on the higher time frames, and that's multi-time frame analysis. That's just all the people that bought in 2001, 10 years later, they made all that money, whoever, like, and the cycles are changing, and all that macro money is just, it's leaving the precious metal sector. It's just leaving it. The stocks were starting to outperform. The stocks were starting to break out. It was just a changing of a guard. It was a capital rotation event in favor of stocks. Yes, it had a bullish correction that looked like it was going to go up, but it's the if you don't put in context of the higher time frame and you understand that you're not in the optimal situation. I'll show you here. Look, I'll go back here in the monthly for silver, and let's look at even here, this one here. Here's the breakout here, and here's the breakout back on the monthly chart. Look how I was not stretched, guys, from look, I was coiled and tight close to the 3-year moving average back here.
Mm-hmm.
I was coiled and tight here close to the 3-year moving average, breaking out to the upside. I'll put it right here. So that's low risk entry. We're starting to get stretched here. Silver, it's not, there's still a lot of room to go up there. It's starting to move up, but it's still, we're starting to move up there. So on the higher time frame, I think it's still got a bunch of fuel left. So that shorter term correction has a higher likelihood of resolving upwards. But the more you wait in a bull market, these corrections, they have less and less chances of materializing. These low risk entries, here's like, let's say, I'll show you the silver bull arrow back here. Here, nice base breakout. So that's your first one. Then, okay, here's the first important correction, breakout. Here we get another shot at glory, fine breakout. After that, we got the GFC. Here it created the next one. I don't know exactly where that is. And then, so after the initial breakout, you get three additional continuation breakouts. Sometimes the fourth one, you like, the more we're deep in it, the less you got to trust these things. So now you can make a case that this was the original one. We've had one here, and eventually we're going to have a second one here. But it's like, whatever's happening now, I'm going to remove these lines here. We haven't had a meaningful correction. Like, we're still waiting for that meaningful correction to start there. It hasn't started. So if ever this shorter term time frame, the 8-hour chart I show you, breaks to the upside, that means, let me put my little path arrow. We're probably going to go up a little bit more, and then do some type of, then we get the meaningful correction, and that will be the next low risk entry point. It's after we get an important, pattern like this, or maybe it could be shorter, it could be a few months, it could be a year. That's for me, those are low risk entries. So I'm not saying, look, as long as the price is above an inclining 12-month moving average, hey, there's no problem, guys. But it doesn't mean you could buy at any time because you're above a 12-month moving average. Because look at that here, anybody buying here, you're super stretched from the moving average. It's like, what are you doing here? It's like you're just begging for a rug pull. So that's the setup there for silver. You just let's see if that 8-hour chart resolves upwards. Let's see if that daily chart resolves upwards with a close above 38.50. Then we get another shot at having another burst before we actually enter a more important correction. And I love these important corrections because they create low risk entries. There's no reason to hold through that. Again, if unless you're a stacker, you step aside, you avoid the emotional capital erosion. That's a real thing, right? When poker players go on tilt because they get a few bad beats there. I have to make my money back on the next hand. It's like, well, that's the same thing in trading. We go through that. Here, look how crazy that was. Sideways. I'm going to hold through the correction. Bam. Market comes in and just hits you in the stomach 2-3 times. It's like, then you give up here and then it moves back up. But the idea is maybe you shouldn't have been in this all here when you started losing rising momentum here. Maybe when this bullish looking flag failed, maybe you should have just exited. There was no reason to hold through that. That's a silver chart. I think we've covered that's pretty good there for the silver chart there.
Yeah, no, I'd say so, Patrick, and thank you. And I think you made the really important distinction there when you said that if you are trying to trade this and profit from that point of view, then this sort of multi-frame time analysis is incredibly important. A lot of people that are watching this are going to be similar to myself. They're stackers, so we would look at this and find it very interesting. But at the same time, we're thinking, 5, 10 years down the line. So the important point there is that I always think there's two different mentalities and two different approaches in these situations. So just bear that in mind for people watching. But that very interesting that we've got a very bullish sort of yearly looking chart. But actually, when you break it down like you have done, actually it's telling a bit of a different story in the short term. And again, that's just the whole point of doing multi time frame analysis, isn't it?
Yes, correct. It's like, yeah. So stackers, they should look at the yearly chart. Well, stackers, they shouldn't care about the chart. If you're looking at a chart and you're a stacker, you're not 100% a stacker. You're a stacker / long-term investor, right? A true stacker, he'll never convert back to fiat. Like he'll just trade his ounces eventually, maybe to buy a house or something, maybe to fiat intermittently, just to if we're still in the fiat system. But a stacker does not care about this price chart. He should say, Patrick, I don't care. I don't care about this chart. I know that my ounces will buy me pretty much over long periods of time the same amount of goods, the same goods. So that's for the yearly charts. It's more for a long-term investor. And so the trend's up, but for that candle, that's a yearly candle. So all that we talked about, that 8-hour chart, the daily chart, even the monthly chart, it's all encompassed in this candle. It's crazy, right? We're like zooming in to the atomic level and looking at the molecules, like see how they work things out. But if you take a real step back, you go, silver is up in a way there.
No, it's quite compelling to say the least. I know that one of the charts that I wanted you to show, because I know you've posted this on X recently as well, is again on the theme of silver while we can, is silver to oil, because that chart is showing some incredible information over 150, 160 years. So if you can bring up that chart, then what is that telling us at the moment? That would be fantastic.
Okay, so essentially this chart here this is probably the one you were referring to, right?
Yeah.
Okay, I'll talk about a little bit about this one there. So I love the data that we have there on TradingView, because I got some data there going back to 1861. And again, this is to reinforce the fact or the point that you should not worry about fundamental stories and narratives in regards to price to justify why you're buying gold or silver or oil or silver. Because look, I have the silver chart on a yearly close basis, it's the little dotted one. And I have the thick black line, which is crude oil. Look at that. Even back in 1861, before the Fed, my goodness, before the Fed, like before you want to
Hmm.
blame the Fed for everything that's evil there, before the Fed, silver and oil were tracking each other. Both different fundamentals, both different narratives, both different mining companies, oil, like whatever it is. And they just track, look at that on a yearly close basis, the trends. They track, look at that silver climbing up, look at that, everything is going up nicely together, down together. It's like when I see something like that, it makes me think I know nothing, but I do know that the chart is the aggregate of all the things that I don't know. And it comforts me because I'm like a little baby. And don't worry, Patrick, wherever oil goes, silver goes. Wherever silver goes, oil goes. And I sleep like a baby, no matter if Trump says drill, baby, drill, like that stuff. When you're aware of a chart like that, you don't care what the president says. You don't care what that guy says. You don't care about anybody, what they say. You just know that that chart is the truth. It's been that for 160. And some people look at that chart and say, Patrick, yeah, but it's different this time. Whatever, AI is going to lower oil inputs. Like, I don't know, like all the fancy stories. It doesn't matter, guys. It does not matter. This is the chart. And on this chart, I overlaid purchasing power. So essentially, it's like inflation, compounded the inflation rate, inversed, just to show you how the long-term trends. So if your purchasing power is reflating, that means the chart's going down. Look what happens to gold and silver, oil and silver. The oil and silver, yeah, they lose value because the fiat is increasing in purchasing power. But now we've been in a solid uptrend in purchasing power destruction. So as this red line goes up, we're destroying your purchasing power. And look over these accelerations. Oh, flat acceleration and destruction of purchasing power. Oil goes bonkers, silver goes bonkers. And over long periods of time, as soon as we have a reacceleration here, it just fuels silver, oil to maintain their price. So look, guys, people sometimes they say it can't be that simple, but it is that simple. It just is. We're doing uptrends, silver higher lows. Now it's going to do a higher high. We got the gold chart breaking out versus inflation, higher lows, higher highs. Even if oil's down here on a yearly close basis, I don't think it's going to stay there. There, oil eventually will follow its brothers, its metallic brothers, gold and silver, and oil will eventually go up, unless there's a catastrophe or unless the governments become super responsible. They start destroying debt, so reducing the amount of dollars in circulation. Each dollar is worth more, and unless they do that, it's like that thing's keep going up. And if they do it, well, fine. Then everything costs cheaper for you because your US dollar is gonna appreciate in value. It's win-win. It's like this is like almost like a zero-sum game, you know. It's more for traders. They want to spot Patrick. Well, yeah, okay, it's a yearly chart. Can't do much with it. Well, do like we did before there, you know. Come to northstarbatcharts.com. We do it all the time, or do zoom in on the smaller time frames, then you could trade it. But the macro is 100% bullish long term for oil, for silver, for gold, for all that stuff. And even this, their destruction of purchasing power still, it helps also US stocks, right? Like US stocks help, it helps Bitcoin, it helps everybody there. But what happens for silver and oil and the commodities, it's when the destruction of purchasing power accelerates too fast because I'm going to have to show you this chart there. I know it's my debt chart. Let me just pop it up. This chart's kind of important. Where is it? Scroll. Yeah, there's a cool feature here on X there. You could highlight charts, and some of my important charts. The destruction of purchasing power, which it's not, you see, the destruction of purchasing power is bottom left to top right most of the time, but we know that there's periods within that stock market outperforms oil, silver, they go sideways, they go down. It's when it's the instigation of all that. It's when we get a crazy recession and the markets, this is total public debt, guys, bottom left, top right. I think we're at 37 trillion. I think in a couple of years, we're going to be at over 40, 47, 48. I think in less than 5 years, we might be in 5 years, we're going to be probably be at 100 or 75 trillion, some crazy number. I'm not impressed by that number, because if you'd be impressed by a number, if somebody back then, 1966, told you that we'd have 35 trillion and he was only at 319 billion, he'd say, oh, the system would break. The system would
Hmm.
break. Just like when I tell people oil could go to 300. Well, no, guys, there's no issue. Could have $1,000 oil. Doesn't matter. If the wages go up and the ratio charts of wages versus oil stays within the range, it's fine. You could have $1 trillion oil. It doesn't matter, guys. That's a fiat illusion. As long as the gold price goes up, as long as the price of everything else goes up, we're just living in, just an illusion. Look, think of all the other countries that have a billion zeros around their currency. It's fine. People can live day to day. It's not the end of the world. You can't live in the past saying because it's 35 trillion and because if we hit 75 trillion, it's a catastrophe. No, what causes the issues is the rate of change, is the accelerations and decelerations in that upwards momentum. And you'll see here's the distance from the 6-quarter moving average. Like recession, bam, they have to start printing or the government takes on more debt for whatever stimulus programs, the whole shebang to save, the economy. Here, explosion in distance, you're distancing yourself from the moving average. Explosion, recession, explosion, recession. See, look at all the explosions, there are all recessions there. That's what instigates these inflows in gold, silver, oil more than the stock market. And look, we're low here. We're still low. It's a quarterly chart. So this is going to be with hindsight, we're going to look at that chart and see it. So it's not very actionable, but we're not high and unwinding. When the total public debt, the acceleration was high and unwinds, the stock market loves that, right? Look at here, 1980s, early 1980s, all the way to 2000s. Even if the total public debt was going up, the momentum was decelerating, the upwards momentum was decelerating, and that the growth stocks, they loved it. If Bitcoin would have existed in 1980, man, it'd have a much bigger run than it did now. There'd be just crazy
Hmm.
there, that this huge run. So we're here, so we're kind of a medium low. So as soon as that turns up, it's game on there for commodities to outperform SPX, because right now there's not enough commodities outperforming the SPX. Yes, gold's up. Gold, maybe silver, coffee. I can't remember. There's a few that are outperforming the SPX marginally, but most of the commodities are not outperforming SPX. You cannot have a commodity bull era if you're not outperforming the SPX. It doesn't matter if your nominal price is going up. You could be in a bull market on your own price chart, but if you're not outperforming the SPX, I'm a huge hedge fund. I'm there and I say, okay, well, you're not outperforming SPX. I'm just going to keep my money, in the SPX. So
Hmm.
we need this, Robert. We need a recession. We need a bear market in the stock market to instigate the acceleration in the money printing, and then it's going to be a glory time.
Yes, potentially off to the races there, to say the least. I do also wonder, and again, I'm not sure how much of the psychological impact there'll be when silver does get to say $50. But I think that there might be a fair few people around the world who get excited by that and then go, right, we're back to where we were in nominal terms in the 1980s. I'm selling. To me, that just creates more opportunity because I think about it on a very long-term point of view. But all of that being said, Patrick, just thinking of other charts, and thank you for going through that silver to oil. I've got my own opinions on that. I think that's going to go much higher as well. Are there any other like ratio charts? Any other stock market charts? Anything else of interest at the moment that you think people need to look at in this video recording?
Yeah. Well, let's go back to the basics there. We just got to show the gold chart. I have to show this gold chart because, again, we like back in April there, even Kevin Wadsworth there and myself there, we saw we were stretched from the moving average
Hmm.
back in April, and gold has just went sideways since then. See a whole bunch of wicks here on the smaller time frames. So again, because price is because you're stretched from the moving average, and we say there's no low risk entry, does not mean again that the rising uptrend is done, right? Because you're still above an inclining 12-month moving average. You're still like everything. It's an uptrend. It's just fine. It's just if you're on the sidelines, there's no low risk entries. And gold also did a measured move right here, so you would expect some type of. I'm wondering. Let me go in the smaller time frames. See, even here on the smaller time frames, we're moving drawings. I'm on the 8-hour chart. Let's do some multi-time frame analysis.
Mm-hmm.
For gold to break out here, oh, this is probably. Oh, what happened here? Here, horizontal ray. Probably need a close up here somewhere there for gold there for us to, for me there to get bullish again there. See, because all this is opportunity cost for a trader. If a trader is holding through a correction, again, that correction could have been way more violent. Right now, it's a beautiful consolidation. So you need to wait until that consolidation ends. Here, there's another, see, there's going to be maybe a line here. If ever that gets broken out of, then after that, we're going to have a test of that longer term descending trend line. And here, reaction morphs into existence. Here, reaction. So that's the bullish roadmap there. But you have two steps to overcome, right? There's two steps before I get bullish. Once again, a resumption of the higher time frame. That's step one. Mm-hmm. That's step two. And then that's step three there. There's three easy steps that needs to be done for that to get bullish. Until that happens, because guys, just imagine sometimes, okay, let's say you get the first step, but then after that, it takes forever for that thing to work out. Let's say it gets, get a crazy back test here. Like it could take time there. Let me move that just for your imagination. Often because we're in a trade, we always imagine the best case scenario, but it could take a lot more time before that thing plays out, right? You just don't know there. So that's it. The gold chart still 100% still in correction mode. Nothing solved here. There's what about the daily? The daily is probably the same thing. Yeah, remove drawings. Don't be afraid, guys, to remove drawings. I do it all the time. The more you practice, don't. At the beginning, I fell in love with my lines. I wouldn't want to lose them. I don't know. I can't redraw that line the same way. But that's at the beginning. Once, just practice. Draw the lines, erase. Draw lines, and sometimes you'll redraw them different. You'll observe the chart through different. You'll notice different lines. Often, if I have a position in something, I'm only going to see the lines that help me. I'll just see the support. I won't see the resistance. And then, it's like, I think sometimes, people say, oh, if you don't have skin in the game, I don't want to listen to your analysis. I rather listen to somebody who does not have skin in the game because that guy's unbiased. Because if a guy has skin in the game, he's going to do his analysis. He's going to skew it to make it look bullish because he wants to reconfirm his subconscious need to validate his decision. And I'm going to trust that guy. That guy has a position. He's dangerous. It's not because he has a position. He's risking money. So I'm in the same boat as him. No, if you're both risking money for the wrong reasons, you won't see the hurdles, upcoming hurdles. You won't see your stretch from the moving average. You'll say, this time's different. You're going to lie to yourself. Don't do that. Trust me, guys, sell everything you have and then do your analysis. You'll be way more honest with yourself. Way, way more honest. You'll see clearly, man. You'll see hey, man, I did break rising momentum. Oh yeah, I did lose a rising trend line. You'll see all that thing. Here's gold. Here is, see here, look at that. You had a breakout. You had a breakdown of that rising trend line. So it just means that rising momentum as defined by the angle of that rising trend line got broken, got retested here to the moon. No, not yet. 1, 2. What's beautiful about the gold chart, Robert, it's just, even here on the daily chart, you got a beautiful trend line there. 1, 2, 3, 4 touches. My goodness. If that breaks out, you got to respect it. Whether it fails or not after, if ever that breaks out, those are lower risk entry points. But again, this is the caveat. That's why I'm scared about this breakout here. Why am I scared? Because look at the monthly chart. Look how stretched I am from the moving average. I don't like that. I don't like that. It's like, this is the market telling me that whatever's happening here on the shorter time frames, okay, all right, let's take it with a grain of salt, but I'm stretched. Historically, every time I've been that stretched, I've consolidated for a long time. Look here. I consolidated here for 2006 all the way to 2007. I consolidated for a year. Here, I was stretched. Then I had the GFC. I went down and went sideways for a year. Here, here was the end of the bull market. I went sideways, and then after I got a huge pull rug. So here we were stretched, not even that stretched, and we got a two-year pause, right? 4-year, 3-year pause we got, and we weren't even that. We were stretched. It's not about just being stretched. It's about being stretched and losing rising momentum. So step one, you're stretched, fine, let it go, let it get stretched. But once you lose rising momentum, that's a correction. 100% most of the time. I can't say 100% most of the time. It's like most of the time. I have to nuance my words. Something because I don't know because I'm French there. I had this a cop out. What is it? And I have a built-in excuse. Oh, I'm French, guys. Don't worry about my English words. Patrick, I bought. You said 100%. I bought.
Yeah, don't take
Not
it as
financial
financial advice,
advice.
people. Yeah, exactly. Not financial
Thanks.
advice. Okay. I'm glad you beat me to it.
But look at gold. It's like it's super stretch. I'll show you something that's more omnious.
Mhm.
Here's gold in the Swiss franc. It lost
Mm.
it lost it. It's like we're seeing the future. I remember back in the days. I don't say I knew I was looking at the weaker currencies. Gold was breaking out in Australian dollar. Gold was breaking out Canadian dollars back in 2019, 18 back then. And it was everybody, hey, gold's going to break out in gold. It's going to break out in US dollar. Like I was super enthusiast there. A little lucky, I guess. Sometimes I wasn't looking at everything. But now look at that. Gold's breaking down versus the Swiss franc. Lost a rising trend line. Is that what's coming for the boogeyman there? The correction, is that what's happening for gold soon? I know that low risk entries are not found up here. I know they're found down here, right? Like the greatest gains in the shortest amount of times are found when you're coiled and tight. I keep repeating
Mm.
that. People, please don't get angry. It's the truth. It's the look, the greatest gains in the shortest amount of time happen when you're coiled and tight breaking out. It's just that's just it's mathematical there. You're close to moving averages. Nobody cares. Nobody's in the trade. Nobody's telling you about their great gains with a Z there. Like there's no of that. So there's a lot of buyers that are left there to buy. But when you're stretched like that, you know how crazy the news were? How was your channel back in April? Like I'm sure repeg, remember revalue. It was that the government, the US is gonna revalue the US the gold. Like you hear all these crazy stories there when you're close to peaks. So look at that. You see that gold and CHF. I don't like that at all, one bit. I don't like that.
Mhm.
That's what happens. Maybe the correction will be short, but as a trader, I'm just going to wait until I have evidence. I'm not going to act until I have solid evidence that the correction is behind us and we resume upwards. But I still can't shake that feeling that because of that the longer term we're stretched there. It's just I just don't like that there. I would love to have a much bigger reset. I would love to have a much bigger correction to create a safer entry point for the traders, for the swing traders, for the position traders, and even investors. If they want to add it to their stack of gold because they like the long-term picture, fine. But on the monthly chart, there's no entry right now.
Yeah, some compelling evidence there, I have to say, and I think it's important to make that distinction again that if you are listening to this and you are a stacker and you're thinking very long term, the price probably won't matter to you. But if you're looking for safe entry points or to be a bit contrarian or add to your positions and you're possibly trading, then again, this chart analysis on multiple time frames is incredibly important. And that to me shows that if I'm going down that route, I would be either sitting on the sidelines or looking at caution at the moment, given the various frames that you've shown, not just in gold, but also in silver as well, Patrick. So again, a massive thank you for taking the time out to do that. Uh, if people want to find out more about yourself or give you a follow or follow your work, how do people get in touch with you?
Sure. Well, Bad Charts One on X guys. It's all this stuff. It's out there, but the in depth. If you want more interaction with Kevin and I, and it's all behind the paywall, guys, on northstarbadcharts.com. We created that one stop shop there where you get I don't know. There's a wealth of tools we have on the website. You communicate with us. We get that in depth stuff, but or else just have fun on Twitter there. It's cool also there.
There you are, definitely a very good follow to say the least. I'll put links to those places in the show notes as well that comes with this, Patrick. A massive thank you for your time. Look forward to having you back on in due course.
My honor, Robert. Thank you.